talking about retail because it's Black Friday, and this is a very important quarter and a very important set of weeks for retailers out there. How important is the retail and consumer story for any investment thesis in your mind right now?
Happy Thanksgiving, Dom, and thanks for having me on. We think that the consumer is relatively strong and will support the economy, but it's problematic in terms of investing in retail because it's really a tale of two cities. So homeowners are doing spectacularly well. That's 65% of Americans tend to be wealthier. Of course, not affected by CPI shelter increase, but actually have more wealth because of their owning their own homes. And then, of course, then the 35%, the rest of the 35% is pressured. And so we think that from a GDP perspective, retail will be supportive, but not necessarily great for every retail company out there.
How much of that has already been reflected in the markets, Jay, in your mind, that this idea that we've seen a pullback, a market one over the last several months for the better part of this year? Is the market accurately reflecting what could be a weakening consumer environment in this country right now? I don't mean just for retail, but retail spend and consumer spending makes up the bulk of the U.S. economy.
We think it is priced in. We think the U.S. is by far the strongest economy in the world, particularly because we have an 80% cost advantage on energy. And also, we have a very, very resilient housing sector and auto sector. And those are the two sectors that normally buckle under Fed pressure, but we have a shortage. So normally, where most of the weak consumer demand comes from is from unemployment. And of course, we don't have anything approaching that right now. So we think the economy will be quite resilient going to next year. That's why we're bullish on both stocks and bonds throughout the whole year.
All right. Now, within that stock market, there have been some places that have been beaten up way more than others, given the rise in interest rates. You look at places like technology, you look at places like perhaps real estate. Those are very pressured right now. Is it time to buy for any of those beaten up sectors?
Well, we think so. We're way more bullish about inflation declining next year than the market and even some of your guests this morning. The reason for that is that our research shows there's at least a 5% bleed through of energy price shocks to core, and we're going to be anniversarying all those shocks. So we think that rates will steadily decline. So we would be in sectors like you mentioned, REITs, that have been really smashed and probably oversold because of the increase in rates. So if we do have steadily declining rates as inflation comes down, a lot of REIT sectors, particularly the beat up, in fact, even retail, the super high quality retail tech REITs, also hotels. So the more cyclical REITs, I think were oversold, entertainment REITs. So we would be focusing on those. If the market rallies, then tech will do well. We don't really view tech as being that interest rate sensitive, although everybody sort of thinks of it that way. It's just a high beta sector. But so if we're correct about rates coming down, then of course tech stocks are going to do well. We don't really focus on tech stocks. If you look at our large cap dividend stock, we only have one tech stock right now. But so we'd focus on more of the cyclicals, buy some fixed income like preferred stocks if we're correct about this coming down.